Good morning, everybody. Hope you all had a good weekend. Off we go again, and a big week coming up this week. Good morning to Stel and Kay.
Good morning.
Good morning, everybody.
You all right, lads? Have a good weekend?
Well, you want to know? I was in a Greek island for the weekend, so
Shock
horror, yeah. It was nice. It was nice. There's a lot of bad things about Greece, but these escapes to nearby islands are paradise.
Yeah, lovely. I bet, mate. I bet it's nice living by the coast, isn't it?
Yep.
That's very nice. I had a weekend trying to get my internet distribution into the house back up. Finally, it's working, but I missed on Friday. So that's a bit of a slightly different weekend within the UK.
Yeah, frustrating one, I bet. Yeah, it's always a pain in the arse when your internet or you get tech issues. It just throws your routine right out the window, doesn't it? Really?
Oh yeah. Feels like I missed the whole week.
Yeah, exactly. Well, you didn't miss too much, so not too bad anyway. And as we say, markets are here this week, so on we plod. Right, just before we start, I want to say a big welcome to some of the folks who have joined our trading platform, coming from the Flow Show, using the discount code that I've got up there. Welcome to you guys and girls. I hope you're settling in nicely. You can always contact us via the room, through the room, if you haven't already. But we've been in contact with a few guys, had a chat with them, and they're doing okay so far. So what I want to start off by doing is get this out the way nice and early. If you do want to join the Forex Analytics platform, I've just popped a link in the chat there. You can do so, take advantage of a special discount I've got for that, if you have a look at that page there. And also we have our traders funding program ongoing. So if you are trading, you're doing okay, but you want to scale up your trading, we've got a program just for you guys and girls if you want to join that as well, and the link is going up in the chat as well there. Have a look, check it out. It's particularly useful for some of you US clients, customers, because you can avoid the FIFO rules, and we've got several US customers from the platform in there as well. One of our very own Brian Adams, who's in the chat. So don't take our word for it. If you want to come in the platform and ask people who are actually using that room, you can do so. Just to show you also, we have a separate discussion for the traders funding program there. So for anyone who's in the program, you can come along and use the discussion in that room as well, just for you. Ask any questions you like. So that's it for this morning, as far as pumping our services. So we'll get right into it now. I'm going to start with the Bank of Japan, because we've had these two new boys joining the parade, if you like. They're replacing, one of them's replacing a known dove, Takata. He's meant to be a bit hawkish, if previous outings have shown. But the thing I picked up this morning from the comments, they did a press conference with these two guys joining. They weren't really as hawkish as what many might have been expecting. Some of the comments you can see there pretty much in line with the current Bank of Japan's thinking, not really questioning, making mild comments, like the headline there that YCC has points to consider, including market function, but no real breaking from the script, if you like. Probably the biggest comment was from Tamura, saying that negative rate policy has exerted a certain effect on the economy, but there are questions on how much marginal effect the policy still has. So a bit of a question there on negative rates. Some mild comments on FX and that sort of thing. Not really anything that I would take away and saying, oh, wow, there's potentially big changes or big conversations going to be happening at the Bank of Japan. They have spoken about exits, but nothing that anything's going to change anytime soon. Kay, I want to ask you about this. You see anything in these comments that I've missed?
They're not really stirring the barrel yet, but compared to how Kuroda is handling things, they are, let's call it, a little bit more nuanced. It's not outright all keep pressing, but yeah, I mean, having been painted as more hawkish than the current members, we might call it a soft entry. This being said, so one of the two, and I think it's Tamura, he's replacing Kataoka, who was an uber dove. He was even saying at some stage, end of the last fiscal year, or actually over the whole year, that he wanted to do more. So in that sense, that's a change. But no, they're doing it Japanese diplomacy style, and going it into it a bit soft right now. But we'll see over time.
Yeah.
They do mention some exit policies. Not saying it's right now, but I have the impression that over the course of Kuroda's last year as a Bank of Japan governor, we might see finally some changes kicking in. Let's hope they use the small window opening still there to do something. Otherwise, they are going to be trapped into eternity.
Yeah, I mean, I'm not going to paint these guys, into a corner straight off the bat, but it is something we tend to see from central bankers when they're not in the hot seat. So if you've got new people coming in, they're all big talk in whatever field they've been in previously. But when they get in the hot seat, they tend to really sort of dumb it down a bit. And then conversely, when these people leave, I mean, especially with Fed members and ECB members, when they leave and they're not responsible or anything, then they get back on the strong rhetoric and, putting the world to rights. So it is a bit of a feature with central bankers when they get put in the hot seat at last, I wouldn't say their asses go, but you get my drift that suddenly they're not as inflammable with their comments as they were when before they sat down. But anyway, that's something to keep an eye on. It was important to look at these two guys this morning just to see if they did set their stall out and have a say, give the price yen moves, anything to grab a hold of, and really it was nothing. So on we go from that. Right, just to kick into some of the other news. China, they're apparently planning a 44 billion real estate fund to help the struggling sector there. Again, is along the lines of what we've been saying, that they are happy to step in and support sectors that are going to do badly. Foreign Minister Zhao is apparently getting seriously prepared for Pelosi's visit to Taiwan. So this is going to be something that is going to keep bubbling over the days ahead as this potential visit by Pelosi to Taiwan happens. The rhetoric is a bit strong at the moment, which may get risk traders looking at that nearer to the time. Is China just going to be speaking strongly, or are they going to act strongly, and how strongly they may act? Is it just going to be a show of strength, the usual flying planes over the air zone, sailing ships, doing drills, that sort of thing? But the rhetoric does seem quite strong as far as I can see at the moment. This isn't a soft thing that's going on. So we have to see what goes on there, but keep that at the back of your mind just as the days progress. Over to the ECB, and Lagarde was out late Friday with, in my opinion, just quite a hawkish interview in the German press. Now, maybe playing to the crowd, obviously a very inflation-averse German population over there. But she said they will keep raising until inflation falls back to target. So no, we watch data, we'll do this, we'll do that. It seemed a pretty strong comment. We will keep raising while inflation is high and until it falls back. So a bit stronger even than what she said in the press conference, where she poured a bit of cold water onto the September forward guidance, leaving it a bit open. It's going to be data dependent. which left us thinking, you know, any sort of soft print in inflation and the market's going to scale down expectations for 50 pips or whatever's going through its mind. But the fact that she said this just adds a bit of a hawkish slant to it. No real move in the euro that I could see on this, but I think we're still very much in a buy the dip mode in the euro at the moment. And you can see that today we've had a little move back under 102. It hasn't lasted, and we're pushing higher again. So still in a bit of range. Got to watch some of these highs up here towards the 70s, 80s to see if we're going to get a decent move. But that was a pretty hawkish comment from her. We've had some other bods out this morning. Kazakh saying they should be open to bigger hikes and discuss bigger hikes and, you know, keep pumping. He's pretty hawkish, one of the most hawkish at the ECB. As you can see there from the chat, we've had Visco out, who's saying gradual steps. Gradual means step by step, not slow, and the markets have understood the ECB very well. He may have a point on that, given the scale of the moves that we saw in the euro over the ECB and such. You know, we're not talking about hundreds of pips flying around here, but decent ranges. On the data front, as you can see there, Germany's IFO came in less than happy. Really looking at problems there, expectations really taking a bit of a beating. And the comments there, glass half empty as usual. That's one thing about these guys at the IFO and the zoo. You know, when the mood is sour, they come out with all these sour comments, and when the mood is more positive, everything's jelly and ice cream. So we know that there's problems in Germany, likely to head into recession. Things aren't getting any better, and these latest sentiment surveys are proving that. Going to take a quick look back at the data from last week before I bring the other guys in, bring Stel in. We got the Canada retail sales, which were fairly decent, but they're a bit lagging back in May, so they were higher there. The big news was really the S&P Global US PMIs. Manufacturing showed a dip but held up pretty well, beating expectations. But the composite and the services number, you know, real cratering there in the services, well into contraction. You know, this isn't a small miss. This is deep into contraction here, and that's caught the market on the hop a bit. The market S&P Global one isn't a huge one for the market compared to the ISM, but it is an indication that there are issues. That's going to potentially raise some questions into the Fed. I don't think it really changes the rhetoric for a 75 pip hike. The market hasn't really got out its pram about that. There was a bit of price shifting, obviously, on that number. But it is a tale of two sectors, one seemingly doing okay and one not doing okay. So as far as the Fed is concerned, I don't think it changes their minds. Stel, what do you make of that data from last week?
Well, let's take it one at a time. So the European data was pretty terrible. The Christine Lagarde did acknowledge it, and they, you know, even though they hiked 50, and remember we were talking on the Flow Show on Wednesday, we're saying, look, you know, there's a good chance, a really good chance they're going to do more than 25, and they did 50. And the problem they have is that they are hiking into an economy which is turning, and they did acknowledge it, but nevertheless, we have inflation at 8.5%, and rates are at, well, they were at 0, and now they're slightly above 0. So, and the deposit rate is at 0. So they're still a million miles away. And as I said a couple of days back, it's not like inflation is at 8.5% and rates are at 4 or 5%. There you can kind of say, oh, I'm going to be fine tuning a bit. No, they're way behind the curve. And even though the data is bad, they have to act. And that's what Lagarde is finally giving us. So I think the 50 last week is a hawkish development for sure. The euro is not really responding yet, but it makes me even more have a stronger belief in buying dips in the euro. So 102.8 is a breakout, and then we have 103.5, two very clear levels. The Fed, on the other hand, data is kind of okay. It's mixed. Some of the data is good, some is not. They still should be going full speed ahead, as long as the equity markets are not collapsing. And let's face it, they're not. They're down from the highs, almost 20%, but they're not collapsing. So I think they're going to continue and do as much as they can. Will they do 75, which is priced in for this week? Most likely, yes. So I don't see any reason why the Fed's going to surprise the markets, either doing 100 or 50. There's no reason for that. I going into the Fed, I don't see anything that's going to really move markets massively yet. So but the thing is that the ECB is now starting to kind of try and catch up. In their own pace, obviously, as they always do, but they're trying to catch up with the Fed and the other central banks, and let's see what happens. But I really do think that the ECB is going to raise another 50, and keep going until inflation starts showing signs of retreating. It's as simple as that, in my view.
Yeah, the problem I have right now is just the messaging coming out of the ECB is just atrocious. I mean, she had the press conference last week. Where she poured cold water on the potential 50 at the September meeting, and then she comes out with this interview in the German press, pretty strong, saying they're going to keep going until inflation's under control. And it's just that these messages they send out, it's just a flip from one day to another, and I don't think that's good for the market or the ECB's credibility whatsoever.
Of course it isn't. The problem is they have a lot of people to please. So they want to please the Germans, but they want to appease the markets, and they want to be seen, like you said before, they want to be seen as being hawkish enough to tame inflation, but they realize that southern European countries are going to be in all sorts of trouble when rates go higher. Yeah. So they kind of try to engineer a kind of a soft landing, just like the Fed is, and I don't know how feasible that is.
Yeah. What do you think, Kay?
I think as far as I agree with Stel. The Fed this week is probably going to do 75. I just recall every time that one line from Powell saying we are ready to take some pain or there may be some pain to take. I don't recall exactly the wording, but. So a couple of bad numbers is not going to change their approach right now. We have to bear in mind though that if they do 75 this week, if I recall correctly, we are going to be looking at Fed funds at 2.25% to 2.5%. And then the top end is 2.5. So 2.5 has been noted before as neutral. So it's going to be interesting how they're going to bring it on, bring that one on this week. Is Powell going to hint that there might be at least a solid slowdown in the next ones because he sees data starting to turn a bit? But on the other hand, as Stella also mentioned, the equity markets are not tumbling away. So that's probably going to keep them going. As far as the ECB, they may do another 50 in September. It's still, I mean, they may look through a couple of numbers as well. The issue for me with the ECB is that exactly there is now, from now on, let's say 1.5 months to come in between the meeting that we had last week. And then right after the meeting, we started to have weakening data as well. Now, knowing Lagarde, she might be looking straight away at those. So I'm in a bit in between two chairs. I think euro and dollar. The euro may still respect ranges, euro dollar, I mean, but the rest of the dollars, I'm not outright bullish dollars anymore. And I already said last week that I'm more starting to feel rangy, despite another 75 coming from the Fed.
Yeah.
But the data are starting to show red flags to me. So it might be that on the trading side, we are now more in a kind of sell dollar rallies than opposed to buy dollar dips for a little while. But we can talk about levels and trades later. But I'm starting to shift a little bit myself because I always said, like, as long as the data are not tumbling, don't change a winning team. They keep on going. But it's not only what central banks are doing, which is important in the market, right? Real data are starting to show finally signs of weakening.
Yeah, and we've got a bit of data that we might see some of that coming through in other areas this week. So not much left today. Minor manufacturing survey in the US. The FOMC begins tomorrow. We get a look at some of the house price indexes tomorrow as well. That's going to be key because although we've seen a bit of weakness in the main housing numbers creeping in, prices are remaining up. So that's sort of the final nail in the coffin, if you will, to see whether the housing market is really tipping over. If prices start tumbling, it shows potential affordability problems, and that's going to be another negative signal for the housing market due to the impact of rate hikes. Consumer confidence, that's going to be a fairly big one. Whether it changes any thoughts going into the FOMC on the Wednesday, I don't know, but within that we obviously get those inflation expectations as well. So something big there to see if the consumer is really feeling the pinch. Obviously, the Michigan was less than enthused. It was up in a couple, but some of the other parts the inflation numbers were lower. So that one will be closely watched. New home sales, again, just another look at the housing market from some of the main data. Again, another little manufacturing index coming out, regional bank there. The Wednesday, though, we've got the durable goods orders. Now, we've been looking at the data and some of the metrics to see if we're going to start to get some of this slowdown. We thought it might start appearing in May. It didn't. You know, we were talking about the Target and Walmart big building in inventories and how they stop those. So this might be the one where we finally see some of that coming through. And then is it really going to be affected? Is it become a trend, or is it just going to be a one-off thing? So that's going to be pretty big. Again, I don't think it will change the Fed's mind at all, but it might get the market jumping around a lot. And for the Fed, just to jump back to that quickly, it's not really about the 75 pip hike. It's what about the path going forward? Does any of the data that we've seen since the last FOMC change the Fed's thinking in the path of rates? Kay mentioned that, you know, a neutral rate around 2 to 2.5% is what they're expecting, but we're in the position still of finding what they call the terminal rate. So how high rates will go before they stop and then potentially come back towards a more meaningful level, or the neutral rate. And expectations are up about the 3.5–4% mark from the dots. So it's really all about the path of rates going forward. Is it going to be another 75 in September? Is it going to be a 50? Is it going to be 100? You know, that's the sort of thing that's going to be important from the FOMC. So the data we get now this week is probably more likely to influence the decisions down the road rather than the decision on Wednesday. So just moving on, more housing data, a bit of inventory data there. Again, inventory data is pretty important for GDP because if you get large inventory builds in a quick period of time, it shows, or it can bring into GDP data an increase in activity. But once inventory building stops, then that creates a little bit of an air pocket for activity, and then you can see GDP dipping back. On Thursday, we actually get the US GDP for Q2. A lot of people expecting the US to print another negative number, but we've been surprised before. So that's obviously coming after the Fed, but it will still be important. Again, pretty much for all the news headlines. You know, if the US is heading into recession, that's what will grab the news headlines, irrespective of what the numbers look like. Even if it's down by 0.1, that'll get the market hopping and popping. Then we get some GDP numbers from Eurozone, some data out from Japan. But the week really ends out on a bang with the flash inflation numbers from the Eurozone. A lot of the economies or a lot of central banks will then be going into shutdown for the summer. As we know, it's going to be September till the next ECB meeting. So, you know, well over a month until we get that. So that number could be big on Friday to determine what the market might think the ECB will do going into September meeting. So that's going to be pretty big there. Then we get some other consumer sentiment numbers. I think that's the Michigan final, even though they call it the same as the main number. This is there's two. There's the BLS, I think it is. Or it could be the other one, I can't remember. But the one on Friday is the Michigan final number. So that's what we're looking at ahead this week. In between that, we'll probably get a ton of Fed speakers after the FOMC is done. So expect the usual flood gates to open and them all to be hitting the presses from Thursday onwards, along with all the other ECBs and stuff. Right, so cracking into some of the prices, and yep, as we've been looking at, euro dollar here, you know, we had a bit of movement around Friday, but you know, we haven't really gone anywhere. It is remaining a bid in the euro. I haven't seen what caused this last pop up, so maybe one of the other guys can add to that if they've seen a headline or something when I was prepping for the show. But I'm agreeing with Kay. You know, I think we're gonna see a few ranges. I think this week we're in for some potential volatility around the Fed and into the end of the week. A lot of governments go on recess as well. End of July into August. So, you know, some of this volatility could be dying down after we've had the FOMC and this week in its entirety. But we're still going to be trading data points. So we could find that we're seeing liquidity drop. We see these, you know, tight ranges developing until we get a data point. We get a large move if it's big news, and then we go back to a bit of a snore fest. So be careful, because you don't want to be getting caught out on a data move, getting into a trade and then finding its flat lines for the next 6 hours. But as far as the euro is concerned, I would still be a dip buyer. I'm not really interested in looking at these levels around here. I'd like a decent dip. You know, probably won't get one, but down to parity obviously would be ideal. Everyone will probably be lining up to buy down there, but maybe a move down to maybe the 101s, down to this zone here, 50s, 70s, perhaps. I will be looking at possibly trading a short still into this 103.40, 50, potentially with a break reverse if we get above 60s. But other than that, I'll look to trade the range in this. Kay, still, you got any thoughts on this one? I know still you've been looking at the same numbers we have. What do you think regarding you know, volatility dipping off as we pass these events?
Yeah, we have to remember we're summer markets already, so it's not going to be as volatile as usual. I expected the euro to trade a little bit better after the 50 last week, but I'm still bullish on it in the short term at least. But really, those are the two levels I said before: 102.8, 103.5, and
yeah.
But it's quite slow price action, so I don't really have much to say.
Okay.
Unfortunately, sorry.
Get back on the beach. Go on, off you go.
Okay, see you tomorrow.
Yeah. Okay, euro dollar. You got any?
As I said before, I'm neutral on the euro dollar, but I have two different, a bit of conflicting views, because I think as I said, the market may be shifting somewhat after last week's data from being a dollar dip buyer to a dollar rally seller. So I would say that euro could find bids again, if we make it back to the 101 and a half, 101.30 zone, but I wouldn't rule it out really to go for a move higher. Now, this being said, on the other hand, through crosses, I'm still not a euro bull. I think they are really behind all the rest. And as a matter of fact, if one looks at the crosses, euro is not making too much of a headway. So in the euro dollar, I'm going to be neutral, but probably rather looking to buy dips if we get them. But on the cross side, especially for as long as the rest of the commodities and things don't fall out of bed, I might be looking at and I am actually short a little bit of euro Aussie. I was short a bit of euro sterling. So those kind of things, you know. And on the dollar side, I'm rather a dollar rally seller, but it would be more expressed perhaps through cable or something like the Kiwi, which I started to buy end of last week. So it's a bit. I'm not going to have too much in the euro dollar as such right now, because we are in between the goalposts, right?
Yeah, exactly. And just the same as me, sometimes I don't like trading when we're just floating around the middle of some big ranges. So that's the question of having patience when you're trading and just try and wait for your levels or see what else develops. Mike just had a question. What about the 2 billion options in euro dollar going off today? Well, again, this is a feature that we have on the Forex Analytics platform. So on a Sunday, usually, I put up a lot of the options and you know, where they're spread, where they're based, the sizes for the week, that sort of thing. So we get an idea of where the options activity is centered. And as you can see from today's, we've got near on 2 billion expiring at 102.40.50. Now, we had this conversation with Mike last week because he was looking at an option expiry that was a bit away from the market and whether the price would move up there. This one might be more prevalent depending on where we are at the time. As you can see, we're in the 102.40s at the moment, so we're right in that option zone. And the options can have a bit more impact on the price moves when liquidity is lower. So things like summer, not so much that you might see a move, you know, from 102 all the way up to 102.40.50. It can happen, but what I look for in times like this, okay, if markets are a bit quiet and we're floating around an option expiry, I want to see how the euro dollar is doing versus other pairs. So let's say, for example, the dollar's really bid. You know, we going into the expiries, we see dollar yen, you know, ripping 30-40 pips higher. We see cable dumping 40-50 pips, Aussie dollar moving, all the dollar pairs, you know, putting in a big move, but euro dollar is doing nothing. And it's sitting around this big option. That to me is where I look at potentially trading these option expiries, because what it tells me is perhaps the options are gluing the price to the expiry, and it's moving it out of sync with what's happening elsewhere. And if that's the case, then I might tend to think that, okay, every other dollar pair is moving, this one's not, so there may be a bit of catch up after the expiry passes. So those are the types of opportunities I look for. So if you are looking at the options, keep an eye on the big ones. You know, 2 billion is fairly decent. Something like a 400 is not gonna have much say in anything at all. And just look for those skews. Look for the skews in market pricing, in the intraday trends or whatever. That's where you might get an opportunity to try something. But that gives us something to talk about in another webinar when we have a quiet one, maybe over the summer. We'll do one on options and other bits and pieces. We do like to diversify what we talk about on the show. So yeah, if you're on the platform, you can get the options there. You can see some of the options coming up this week as well, from some of the other pairs. Euro Swiss has some decent size, a bit higher above the market, but we do have a few bits and pieces closer to the market. So it's Thursday and Friday. There's some decent numbers there. Kay, do you want to do your little round robin since you missed out Friday? Hello.
Is he already out for drinks?
Has he gone? Has he gone down?
He was muted. He was muted.
I'm sorry, guys.
No worries. Do you want to take over and do your stuff?
Yep. Right. First of all, let's have a look at this. Yes, Brand Rainbow time. Gold. Gold. That was a decent one. Oops, I messed this one up. Yeah, that's okay. That was a very decent hold, as we can see. This triple bottom now in around those 1670s in gold, and it really rebounded strongly from it, going straight back above the level that couldn't hold and break last week, earlier in the week. So the gold market has reacted to the weaker data coming out, which is very nice to see that it actually can react to stuff like that. So that's a promising hold, in my opinion. So now we have to look if we get a retest or so. Call it 1700 or just below 1700, and then can bounce again. That will be very promising for the ones who want to buy gold. I know a few in our chat room have done it, so congrats to all of you guys who caught that bottom. So that's a promising hold, in my opinion. Silver is a little less spectacular because, as I've been saying already many times, silver is an instrument that's been used for the word escapes me, industrial use. So if the data starts to weaken, we might see this gold-silver ratio go up a little bit again. But also, it did hold those levels, which is also pretty promising. I really would love to see this one retake 19 or even 1920 to add to what I have. I did buy a little on this dip the other day, and then sold some of it out, folded the rest into my really long term, and now I'm waiting to see what's happening with this one. Above 1920, I may actually start to add a little bit, and then if ever we make it back above 1940, I think that may be it for now, and we can go back into higher levels.
What do you mean, if ever? You mean when?
When?
Okay.
Sorry, still my English.
Talking my book. Sorry.
my English is so bad. Yeah. So that's for the metals. As I was saying, so I've shorted Euro Aussie last week because I was not impressed by the ECB's 50 BPs, and also by the fact that this thing is really holding and capping very well every time we go up above 148.5 to the 149. It's really still feeling heavy. Of course, I'm going to have keep a very close eye on what's happening in the commodity sphere. But as I was saying earlier on the show, I'm still not a euro bull. Not only because of the ECB, but also because the data are starting to weaken again as well. And then we can argue that in a risk-off scenario, euro traditionally, historically, does a little bit better because it's a low yielder. It's a little bit like the yen, safe haven, whatever. But I don't think this is valid right here and now. So I'm as I was saying, I'm neutral on the euro dollar for now, but I'm still relatively bearish on the euro. So I want to express this through crosses rather than euro dollar for now. So this is what I mean. I'm in shorts euro sterling in and out this morning on after Kazakhs and another couple of speakers, and the fact it failed to go lower on the German IFO. I flipped into cable for a little while. So for now I'm watching the 120, 20, 30 on the cable, but at any time, if I feel that the euro dollar is putting in a cap, I might go back into my original euro sterling shorts. It's not really something, how shall I say, to keep for a long term or so, but I'm still finding it fragile. And yeah, last week we had a spike then. It came back violently after the ECB. And then we start to cap again around this 85.40 zone. I actually sold it then on the way back down at 85.36 or 37, something like that. Managed some of it around on Friday on the drop below 85, and then now I'm like in cable for now. But it's a kind of a fluid situation, if I may say so. If euro sterling starts to get back below 84, 85 for a starter, then below 84.60, I think we may be in for a retest of a bit lower levels. That for now, and that with an eye on the upcoming BOE, who will likely also raise again. But it's rather to be in a cross than really euro dollar right here and now. So I was saying on the dollar side that I think the market may be changing tack a little bit, going from a dollar dip buying into a dollar sell the rally scenario for now, because of those numbers starting to flip around a little bit. So I bought it. Is somebody talking? No. So I bought this Kiwi last when was it on Thursday or so, around 62.35. It was here. It was around here then. With a close eye on the 61.80 again. This is what I'm going to look out for as a support. As long as this holds, I'm going to try to defend this position. But it's the same. I mean, I'm long a core, I'm adding on dips, and then I'm selling the rallies and trying to defend the core long and see where we can go. I think a renewed break above 62.90 figure could be bingo this time for a move back up to closer to 64. That's what I'm trading right now. For the rest, I'm still core short on my euro MEX. The MEX has been a bit on and off lately because of its proximity to the US. So we had this leg lower on the dollar MEX, but then it stopped, and because of the weakening US data. So be a bit careful on this one. I still like it because of the situation in the euro and the huge differential in interest rates. So this is a pure carry trade. I'm looking to add again, as I was saying, into this 21 anywhere 21, 20, 30 or so to try and look for a final move back down to 20 the figure over time. For a Monday, Ryan, this is roughly. Oh no, I want to mention this one, and unfortunately I missed this one, and I'm not going to blame my technical issues, but I did miss this one to sell up here, at least on the reversal back below the figure. This is an interesting one because the rand was looking really weak for the better part of last week. And then all of a sudden we flipped around. So it may be that finally, because South African Reserve Bank also raised rates by 50 last week. It may be that finally we get like a bit of as we've seen the US yields and the European yields dropping, that we finally see a bit of that creeping in, despite it being a risk currency, but we're seeing the interest rate differentials kick in here as well. So any return up to 17, call it 17.02 to 06, might be an interesting one to have a look at. And
Yeah,
that's it for me for now.
Do you want to have a quick look at dollar knock? And Gavin's looking at that one.
Yes.
Not looking too well.
Okay. So this is the. This is not the correct one. This is not the one that I. No, this is not the correct one. Yeah. So this one, I think the support here around 980 is going to be pretty important. We had a break above, pretty violent break above early. Is it early last week? No, the week before. And then a rejection back down below 1025, and then we had a violent move lower. Yeah, I mean, oil is stabilizing, but as I said, I'm not. I haven't traded this, but all in all, I'm still relatively positive myself on the Norwegian kroner, because whatever happens, Norway is going to be a beneficiary of Europe needing to manage its gas and oil imports. So from that, I think the Norway should really benefit. So anywhere, let me look at it a little bit closer. This one, yeah. So where are we now? 985. So I think already 993, 994 is going to be a bit of a resistance, and then I think it must be around 10 or so. Yeah, even below now, 995. Yeah, I think we are going to likely find some resistance, if I am correct, that the market is rather in a sell the dollar rally mood now. As compared to the buying mood before. So keep an eye on this 978, 980 zone. It has been a zone that held in the past as well. 1, 2 times, 3 times, came back here. We broke below very, very briefly, and then shot up for the final leg up to 1030s. But keep an eye on this 78.80. I think it's going to be relatively important here.
Cool. Cheers, mate. You want me to take it back?
Yeah. Mike, for the rand, what about minimum social income possibly coming into effect in the South Africa sovereign rating downgrade risk? Yeah, I mean it's always in there. I haven't looked at when exactly they are reviewing the rating, Mike. I'll have to look into that.
Cool. Cheers, mate. Just going to look at dollar yen quickly. It's still looking relatively weak. You know, we've had this big sharp moves down. It's testing lows. We are seen to be firmly in rally sell at the moment. So I'm going to be looking down at this key fib area, 38.2, when I'm at 134.40ish, 41. Got a couple of stepping stones on the way. You know, getting down. We had a little move down to 135.5, give or take. So we've got a bit of a traffic area in this zone, sort of 135, 20-ish. In here is potential bit of traffic zone there, so that might be somewhere to look. What we do before the Fed, unless we get any big news or big swings from data or whatever, we're probably going to find out we're going to go a bit sideways until we get into the Fed. What I'll be looking for this one is if we do get a decent rip higher over the FOMC, maybe a knee-jerk reaction, potentially get into shorts. I had a little scalp short last week on Friday, got some decent money in it, then got stopped on the trailer overnight. And that's a theme at the moment. I'm not really getting into anything for longer than a short-term trade. It's just get on a trade and try and run it and see as far as it can go. And that's something you folks need to be aware of. If we are going to see liquidity dropping and volatility dropping over the summer, It may be wise to look at your trading style. You know, if you sort of trade and looking for 200-300 pip moves in a trade, you know, you've got to be thinking perhaps you're not going to get that. So what we tend to do, and we did this when things were less volatile before the pandemic hit. I know me, Kay, and all of the guys in our room, we were doing what we call the slice and dice trade, which is, you know, you get in a trade, if you get 10-15 pips profit fairly quickly, you take half off the table, you lock in your stops and get your risk down to zero as quick as possible, and then see where the trade wants to go. But I've no interest in getting into trades, you know, waiting for 100 pip moves when it's going to do nothing for hours on end, and then you're sitting there questioning why you're in a trade. So I try to get in, get some profits as quick as possible, get some off the table, get my risk to zero, and then sit back and let the market do its thing. And if it's not going to do anything for 6 hours, fine, I've got the money in the bank. Similar to dollar CAD, I've just been stopped out on a trailer. I was trading this Friday, trying to trade this zone down here from 128.50s, 45s, 50s down to, you know, the low 128.50s down to the low 128s, 128.20. A bit of an on-off zone, as you can see here. It's had an effect, you know, going way back. So I bought at 57. I missed. I was working trying to get 20s for an ad down here on Friday. Missed that by a couple of pips. Got some off Friday night. Got some off this morning. 129.20s. Boom! It's gone into complete reverse, and my trailer at 85's got knocked out not so long ago. But again, I'm just trying to scalp, really. I'm not looking to hold anything for any length of time. If the levels don't hold, I'm going to take profit and get out. I was working 50s, maybe a bit greedy, didn't get that. So we are seeing some decent movements, but the levels are holding for now, and that's all we can do, trade the edges. $1 I'm keeping an eye on as well with all the Chinese stuff, and particularly with this Taiwan rhetoric picking up. That one needs to be watched if you're trading it. Still getting these rejections up at the, you know, the high 678s, which is looking fairly important. This week I'm going to be considering maybe sticking a couple of buy stops in just above. I'm not sure where as yet, whether to go just above 679 or go above 80. Again, looking at potential margin of a buy stop, you know, where is it going to hit the next line of traffic? Is it going to be up into this 682 area, which comes just ahead of the prior highs in the 83s? But yeah, one to look at there if stuff does pick up on the Taiwan front. Keep an eye on there. Could be some good moves there. That's about it, unless you guys and girls have got any last minute questions in the room. Catherine, CAD-yen. Kay, you got anything on CAD-yen that you want on there? We had a bit of a breakup last week, didn't we?
Yeah. Yeah, we had a
charts. Let me bang it up.
Reversal there, no? Where is my CAD-yen?
Do you want to take it quickly for that one?
Sure, right.
Let me just end it here. All yours, mate.
Yeah. Okay, CAD-yen. So we had a pretty serious reversal, especially towards the end of the week, on what I think is the weaker data on the one hand, and those weaker yields. So the heavy lifting has been done by the yen, right, on this move. But then we saw here, okay, we had a break, probably a stop run in this, but now we are back above this little crossroad here at 105.5. I would be looking at that, depending on what you have in position right now. I don't know what you're looking at. I really don't know what you're looking at. In what kind of positions you're looking at, but keep an eye on this. I'd say again now the low 107s, and then where this line is going to come in next time, which has been tested and rejected, which is above the 108. So keep first of all an eye on this crossroad, 105.5. Then on the, I think yes, it's bang on the 105. The figure I think that's going to be an important one for the more medium term coming. But then, if we look at the longer term, we still undeniably in this pattern. But we have to be careful what happens around 105 the figure. That for the stop. If it breaks below 105 the figure, then we really there's a risk that we're going back into the jump zone 1, 2, 3, 4 times we came into this 103.5 zone and jumped up again.
What's that line you've got around 106.50? Is that a long-term line, that horizontal?
Yeah, that's an old top.
Gotcha.
That's the top that we had in 2014. That's the top of 2014, which has been tested, broken, but it has only played the ball really once, end of June, this one. But I think if this one is, to me, this 103 half, 3/4, 50-60 or so, this is the do or die zone. Of course, people are going to look at this 103, the figure again, which was the top. But for the real medium term, this 103, 50-60 is to me the do or die zone. If it goes back down, I really wouldn't like to be long. Well, anyway, for one, I'm not going to be long if this 103.5 gives way and with a close below. So that's for the Canada yen.
I think Catherine was looking to try and resell at 106.50. Wondering if it'll get that high.
Okay.
Probably need a bit of patience for that, I think.
Well, we are not that far. It's trading just around 106. Yeah, I mean, it all depends which of the two is doing the move, in my opinion. If we see dollar yen, I think there's going to be this time a few sellers waiting on rallies, perhaps around 137, 137.40. So that could be creating this top or a retest at least of the 106.5 in Canada, and that's possible. And but then let me have a quick look at the dollar CAD, because it looks at a funny level here. All right, so to me the dollar CAD is in some medium-term channels. All right, so we tested the 108 25.40, bounced inside. We have 128.60. Top side retest of the 129 45.55, capped again. So we're range trading here. If it starts to break below 128.25, Kathy, I think that we have a chance to get all the way back down to 127.10, in my opinion. So that might be one other reason why CAD yen is going higher, going back to that level that you're looking at. Keep an eye on oil and gas as well for that one. Yeah, I think it's possible. It's possible we get back up there. Okie dokie.
Cool.
I mean, CAD Swiss, I'm not really watching because the Swiss is such an animal which is moving on its own. I think the Swiss is we can't even get above parity in Euro Swiss, and that to me is already telling a story. With ECB starting to raise rates, Euro Swiss should have retested parity, and it's not even holding above 99. So if you want to play short CAD Swiss, I'd say look for a rally. If you want to play long CAD Swiss, you might be wanting S&B to come and give you a hand, but I'm not sure where they are to really wanting to give a hand. I wouldn't be surprised if over the course of the summer months, in a bit less liquid market, we are going to visit 95 or 96 in euros. It wouldn't even surprise me.
Yeah.
All right.
And Catherine, just to add to your CAD yen, you might want to keep the FOMC in mind. If we do get a move in dollar yen, it's likely to drag, at least from the yen side, yen pairs up, because again we're increasing that yield divergence, rate divergence. That might give you your entry, but maybe be prepared to see it move through a little bit. You might even get a better level than your 106.50. Who knows? Right, anyway, boys and girls, that's it for today. Thank you very much for joining us. I wish you all the best this week. Thanks to Kate and Stel. We shall obviously see you tomorrow. Have a great week, everybody.
Thank you, guys.
Have a great week.
Thanks, everybody.
Thanks, Stel. Thanks, Ryan.